Hi, Steve Sosnick here with today's Interactive Brokers Midday Market Update for Tuesday, June 30th, 2020, end of the quarter. Basically, we have a market that wants a rip higher. There's really no explanation for why it did so late yesterday. There was an explanation, I guess, for why we rallied earlier, which was the housing numbers were good, and these numbers. The problem is the expectations are so across the board that when there's a beat or a miss, they can be just enormous, and markets really want to reward the beats. So yesterday there was a huge existing home sales number beat. Now it still means we were down 5% year over year, which is not a good thing, but markets don't really want to see that. They want to see the change over change. And then today we had the Conference Board consumer confidence numbers come in way above expectation, 98 and change versus 91 and change. And so off we went. It's a market that wants to run into the quarter end. There's a lot of people who are obviously fully invested, who obviously want the markets to rip higher. I think the thesis about about pension funds needing to reduce their equity holdings doesn't seem to be holding at this point. So onwards and upwards. I don't really even want to put a number on it for the rest of it. We could be down as well. It's just one of these days where it's going to do what it's going to do. I think people are stepping out of the way. It is a holiday week. I know north of the border tomorrow is a holiday. And then we have in the U.S. our holiday on Friday. So there's a lot of vacations being taken around, certainly in North America. And this is the kind of stuff that we see on thin days where people have an agenda, and I'm not one of them right now. So I think you're going to have markets moving on that. As I mentioned in a written piece yesterday, the big thing to watch is Friday, the economic number. Now, we've seen markets rewarding good economic performance, but this one's going to be an interesting one because you got a couple of problems. If it's too good, you're going to see some resistance among conservative Republicans that we don't need stimulus. Problem for the markets is the market does need stimulus. The market needs something else to keep it going. We have started to see a little bit of the Fed sort of petering out, although they've been active in the repo market over the last couple of days, although I think that's more technical than it is monetary policy. Remember, there's banks' balance sheets always they have to really pretty up their balance sheets into year end, and that doesn't necessarily affect the stock market directly, but it does affect money markets and repo markets. And I think that what we're seeing there, some of the repo activity from the Fed, is more specifically technical to end of quarter balance sheets than anything else. But markets need the ongoing stimulus. That I have no way else to put it. I don't think that with all the COVID headlines coming out that are unfavorable with states kind of going into reverse, that markets really are in a sustainable position right now without an accommodative Fed and or accommodative government. And I get the sense from Chairman Powell, and we'll learn more when he starts to speak later today, that I think he really wants to put more of the onus on the federal government through fiscal measures than through monetary measures. I think he wants to keep some powder dry just in case, because I think he sees that let's just say that the recovery is not uniform. How's that for a euphemism? And so what I think we're going to start to see is if the number is too good on Friday, that actually reduces the likelihood of a quick and meaningful stimulus, which has in some ways a negative effect on the stock market. If it's too lousy, well, then it's bad. Bad is bad. And remember, there was a the Bureau of Labor Statistics admitted to a misclassification of about 5 million jobs. And so that when you're talking about a market that's looking for an increase of about 3 million jobs, depending on how those 5 million are classified, could be the difference between a positive and a negative surprise. So too much of a negative surprise, that's going to really, that won't be good either. So we need what I would call the Goldilocks number. Not too good, not too bad, just right. I don't really know what just right is. I'm going to assume that it's somewhere around the 3 million positive payrolls, non-farm payrolls number that the market's anticipating, because that would just seem to sort of be the right number. if we start to see positive gains and you start to see people crowing too much, that's not necessarily a good thing right now. A lot of the precedents that I'm seeing are not even all that good either in terms of number of days. There was a Bloomberg article that quoted number of days with 2% moves or more is on a pace that we haven't seen since 1933. Market people should realize 1933 was in many ways one of the real turning points because the market got truly ugly in the beginning of the year and then did rally when the New Deal started to come into play with its massive fiscal stimulus. But 1933 is not an auspicious year is kind of an auspicious year to have as a precedent. Another one that I saw, which is actually even scarier, was that we haven't seen sequential 20% moves up and down and up in markets since 1932, and that was perhaps the worst market year on record. So I don't mean to be throwing a wet blanket on things, but this is actually what the kind of strange situation we're in, where that we need it to not be too bad, because otherwise that's bad. We need it not to be too good, because ultimately the market, I think, is really depending upon continued external help. We'll see where the numbers come out Friday. In the meantime, it's the end of the quarter. There's obviously portfolios being adjusted. There's obviously people marking up their winners, and might as well not get in the way of that, at least until you see the market turn somewhat. Have a good one, everybody. Bye-bye.